Welcome to the deep dive video update. This is a video that I do every week where I pull out some charts that sometimes I look at quite a bit, but right now I'm not looking at them very much because they're not really telling us much of anything. And then I have some other charts that I show just in this video. Now, the reason why I call this the deep dive video is because we have to look deeper to see, are we getting any clues? They may not be really blatant, and I may not be showing them in the other videos, but at the same time, we still might get some insight from them. This is being prepared for Monday, February 24th. The first chart is for information, and this just gives us an overall idea of what is the range of the VIX. The VIX is a fear gauge. When it goes up, that means fear is going up. When it goes down, that means fear is going down. And we can see over a period of time that it tends to settle into a range. When the market's under pressure and going down, we're in a higher range. When we're in a lower range, the market is going up. Well, we've been in a lower range coming up into 2023, but right now we're just pretty much going sideways. Over the last number of weeks, the market itself has not been trending, and 2025 has been kind of a slow year as far as returns are concerned. And so the VIX is reflecting that it's not really picking up any emotion, either to the upside or the downside. But overall, it tends to be positive because we're in a lower range longer term. Okay, then we have another sentiment gauge called the Ulcer Index, which was developed for mutual funds. I only show this chart when we're above the moving average. And even with the decline that we saw on Friday, this hasn't really spiked up all that much. So we're getting a low reading here. There's been really no need to show that. Another study of the VIX is doing a correlation between the VIX and the S&P 500. We're getting a very low reading here. I only start showing this chart when we come in above the dashed line, and we're not there now. And then we do a ratio between the VIX and then the volatility of the VIX, or the VIX. And this is just chopping along sideways too. So we're not really getting any insight from that. We want to keep an eye on how fast is the mix moving. Now, it did spike up on Friday, but we're not getting an extreme reading. What I use to measure this is an RSI based on 9 periods, which is a short-term momentum oscillator. And if we go above 70 or below 30, that's when I start showing this chart in the video. Then we look at the volatility of stocks as measured by the VIX, and the volatility of bonds as measured by the MOVE index. And I follow the red line here, and we are going up a little bit as bond prices have gone down and stock prices have gone, they're trendless, but then we had that big down day on Friday. But overall, we're seeing volatility picking up just a little bit. And this just means that stocks are more volatile right now than bonds. If this line was going down, that would mean bonds are more volatile than stocks. Then this comes and goes in and out of the daily video where it's a ratio between risk on. When this is going up, that's more positive for the market, and folks are willing to get into stocks. That's considered risk on. When they're more defensive, then this ratio goes down. They're getting into stocks that are considered to be safer when the market's under pressure. You can see in 2022, when we were in the cyclical bear market, this ratio was pretty much going down most of the time. Well, if you look over on the right-hand side, we've just been chopping around. There's really no conviction one way or the other. Then just for informational purposes, we keep track on what are the percentage gains when we hit the low in October of 2022. We're up 72.02%. And then we hit another low in October of 2023, and we're up 46.53% from that low. Then these are put out by stockcharts.com. They're technical alerts, and this is for the whole week. And Monday is actually Tuesday is the where we start, and then the last reading that we had on Friday, that's at the very top. And you use this, at least I use this, in kind of a color coordinated type of effort, where if it's green or blue, depending on what color you see, that's more positive. If it's red, that's negative. You can see most of the alerts were triggered on Friday when we had that pretty significant down day. And so, yeah, it was negative overall, and it was being reflected in a lot of the technical alerts that we saw. Then I have 6 different indexes that I follow. And stockcharts.com has a rating scale from 0 to 100. The better that particular index, the higher the score. And when something is really strong, we'll get into the 90s. When we drop down below 50 and even below that, that means that index is looking pretty weak from a technical analysis perspective. So coming in first place this week are the QQQs, even though they're in the 80s. If they were really strong, they'd be up into the 90s, but this is still holding up fairly well. Even with the decline that we saw, we're still above the 50-day moving average with the QQQs, which this is the ETF for the NASDAQ 100. The S&P 500 is dealing with its 50-period moving average. We closed just a little bit above that, and that's holding us support. But when you take everything together, the Qs are still looking the strongest right now. And then in second place is the NASDAQ. Now, this is the broad composite for the NASDAQ. It's coming in at 75.5. Then in third place is the SPY, which is the S&P 500, coming in at 70.3. Then we have the Dow, which is falling under 50 at 47.5. Mid caps, they're really not doing well right now. You can see historically, we're really trailing off as far as the score here, and they're coming in at 12. And then what really got hammered this week were the small caps, which should have been doing really well. We have this period of time that starts in December and will typically go through till March, where the small caps and mid caps should do fairly well. They're just not doing that. And they really got hammered on Friday, so this score is dropping to 10.3. Then we look at a short-term chart, and by short term, I mean that we're looking at shorter term moving averages. And this goes back a few years to get a bigger picture perspective. And we're falling down to the lower end of the rainbow here. These are moving averages going from 10 periods up to 50 periods. Now, I consider the 20 period moving average to be short term, and then the 50 period moving average to be intermediate term. And we're still above that 50 period moving average. So the intermediate term is still holding, where we've actually turned negative in the short term since we're below the 20 period moving average. And this is an advanced decline ratio, and it's based on a short term look, 19 days. But I have another chart that goes with a short term and then a 39-day. That's more intermediate term. But this chart breaks it out based on price and volume, where the other chart just analyzes price. And even with the declines that we're seeing, we're still above the midpoint here based on price and volume. So it hasn't rolled over and gone negative yet. Now, if we start to drop below zero, then I'll be including this in the daily video. We also want to measure how far away are we from various moving averages. If we get too far away from either a 20, 50, or 200 period moving average, we have a tendency to snap back. And I call this the boom indicator. And how you can measure this is by turning this into an oscillator, where if we're getting too far away, we get an extreme positive reading to the upside. If we're getting too far away to the downside, we get an extreme negative reading. We're just about in the middle right now with all the different moving averages that we follow, so we're not really getting any additional insight here. Intermediate term, another rainbow going from 50 periods up to 100 periods, and we're still at the top end of the rainbow. Now the lines are kind of crunching up right here as we've been not trending lately, but we haven't actually rolled over and gone negative. Now, if we see more weakness and fall down into and even below the rainbow, that's going to turn things more negative. We keep an eye on Bollinger Bands, and the way that I implement them here is I use a thing called the percent B indicator, and that just measures if we close above or below the upper or lower Bollinger Band. You can also notice here that the band itself is getting rather thin. That's because we haven't been trending lately. And we dropped below the midpoint, and that's why we're getting a low reading down here. But we're not getting any kind of an extreme reading right now, so I haven't been showing this chart. Then we want to measure how far away are we from the 200 period moving average. Incidentally, you can see where we're right down to the blue line here. That's a 50-period moving average, but we're still green because we're above the 200-day moving average, even though we've been pulling back lately. And this is another attempt at measuring things going from the October 2023 low to Friday's close. And then we have a percent return. If we really start to fall here, I'll also be marking it because this past week we did set a new all-time high with the S&P. We did it on Tuesday and then on Wednesday. And so if we continue to decline, I'll be watching to see how much of a percentage fall have we had since that all-time high, because of this is what is used to determine whether we're just pulling back or if we're actually starting to decline. If we get down over 10%, that's an actual correction. Right now, we're just not very far away, just a few percentage points away from the all-time high. But we are seeing some other shifts that are coming into the market. At least in Friday's session, things were turning a bit more defensive. Now, Friday was options expiration, so that's kind of its own crazy day. What we'll be watching in the upcoming week is these more defensive measures, like staples really going up, utilities going up, even real estate going up, and the growth areas, which have been lagging so far in 2025, they've been underperforming. And the Magnificent Seven has become kind of the mediocre seven lately. We're going to be watching to see, is there a shift in that coming up in this week, or are we shifting back more over to a defensive posture? And that's what I go through in the daily videos each day. All right, then we have another momentum oscillator called the Connors RSI. I only pull this out when we have an extreme positive or negative reading. We are kind of close after Friday, but we're not down below this black line. Anchored moving averages, they're kind of a different way of projecting things forward, where typical moving averages use historical values and then come up with a current value. This tries to shoot things off into the future. And even with the decline that we've seen and the sideways action that we've seen over the last number of weeks, we're still above all these anchored moving averages. And typically these come from a low when we're going up, and it may come from a high if we're really going down, but we haven't broken any of the support levels, and all of these lines are continuing to go up as well. So we're still hanging on to being positive. And the CMB composite, another momentum oscillator. I did show this a couple of times throughout the past week. We were starting to get extreme positive when we hit this black line. Well, we've since retraced from that, and now we're getting more of a neutral reading. And then we're dealing with the 20-period moving average, and we're below that now, so we're negative in the short term. We're at the 50-period moving average. Well, if we continue to decline, next we'll be watching the 100-period moving average. But for right now, we're still well above it. And we want to keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500, just to see if anything's getting out of line here. And the S&P 100 in a more positive environment, it will outperform the S&P 500. And it's been doing that. Now, we saw a little bit of weakness this past week, and we've seen some recent weakness that seems to get dealt with when the market is more positive. We'll be keeping an eye on that. But what I watch for in this chart are any kind of divergences that we're seeing, and we're not really seeing any right now. The point and figure chart, even with the down day on Friday, it wasn't enough of a decline to draw in any new O's. That's what's drawn in when we're going down. And we did go up earlier on when we set the all-time high, but we haven't had any recent X's after that. So this is still looking positive, but there's really nothing new after Friday's close that was drawn on this chart. And point and figure charts do not take time into account. They just say, okay, when it goes up or down by a certain amount, we draw in an X or an O. X if we're going up, O if we're going down. And it could take a short period of time, or it could take a very long period of time. So altogether, with the blue line down below here, we're still looking positive since this line is going up, and we're coming off of just setting a couple of all-time highs this past week. Standard deviation, I usually only show this chart if we come in above the moving average. Well, we've been just chopping around lately and not really seeing a lot of conviction. So we really dropped over the last 10 periods with standard deviation itself. It's not measuring direction, it's just measuring speed of how fast something is going up or down. And the mass index, which had triggered a signal earlier in January, but it really didn't lead to anything. Now we're getting a very low reading here, and there's no signal that's being generated. The Pring Bottom Fisher, which gave us a crossover buy signal in early 2025, which actually ended up being a pretty good short-term signal, didn't last very long. Then eventually we crossed back over here and we're going down, and so there's no signal being generated currently. Long term, another rainbow going from 50 periods up to 250 periods, and we're still well above the rainbow and the lines are going up. So long term, we are still positive. This is a long-term momentum oscillator, the special K. We don't get many crossovers above or below the red line, so I don't show this chart. I look at it and I bring it up in this video just more for informational purposes. And then this kind of comes and goes out of the daily video. We look at a 10-day average of the highs and lows for the S&P. And we were really starting to improve. We got up above this green line, which shows good longer term momentum. We've been falling back lately, and this can be kind of slow. It hasn't really calculated in Friday's decline, at least yet. Now, the anticipation is if we see more weakness, this will come down. And if we actually drop below 50, that will turn it negative. Of course, if we go back up and get to this green line, that would mean things are turning back more positive in the more intermediate to somewhat long-term time frame. Then just keeping an eye on stocks in the US, the S&P 500, and stocks in the EU, and we focus on the German stock market, because that's the biggest stock market in the EU, and it's doing really well right now. This is a weekly chart where we did set an all-time high, but we're not seeing a lot of conviction in the US. We're seeing a lot more conviction right now in Germany. And the correlation is actually wearing down a little bit as the German market has been outperforming the US market. And some different support and resistance levels. We did set all-time highs this past week, and so I redrew these fib retracement levels. If we keep falling down, we'll be watching some of these levels to see if they end up providing support. Ichimoku cloud, this is another support area, but it also has some trending tools in it when we do the full study. The green line, it's hard to see because it lags behind here. It had been going up, which is positive, and then in Friday's decline, it really came down. Now, this chart is still positive because we're above the cloud, and we also see where the blue line is above the red line. So it hasn't switched over negative yet, and this support level hasn't even been touched, at least to right now. Then some broad market measures where I look at the VIX to measure the volatility of the S&P 500. This is the VIXen, which looks at the volatility of the NASDAQ 100. I don't look at this chart all that much because I'm more focused on the S&P 500. And then we look at the S&P 500 on top and then a ratio between growth and what's considered value and showing a correlation between the two. And it had been stronger, but we're seeing a little bit of a drop off here. And we keep an eye on the Dow and the transports, where the Dow didn't set a recent all-time high, but it's been pretty strong, where the transports have just continued to chop sideways. And that's the red line that you see here. And we did see some negative action on Friday with the bank ETF. We want to keep an eye on the financial sector as a whole, make sure everything's going okay with the banks and all the different areas of the financial sector. Well, the bank ETF, it did drop down below its 50-day moving average. It was considered positive when we were able to get back above that. Now we're turning a little bit more negative here. And then we do another ratio between the regional banks, which are smaller banks, and the financial sector itself, seeing some weakness now, even though it's still in an uptrend with this ratio, but it's pretty much been chopping around sideways. If this really starts to decline, that would be much more of a concern to us. That means that there's more problems with the smaller banks when you compare it to the financial sector itself. Then this comes and goes out of the video where it's a staples to tech ratio. When this is going down, that means that staples are underperforming, and that means the market's going up. Folks get into staples in the staples sector when they're more defensive. You can see how it really went up in 2022. Well, now that we've been going up with the S&P, this ratio has been coming down. Now it gets a little choppy at times, and we did spike up on Friday, but we're still in a downtrend. Now, if this continues to go up and we see a golden cross with this ratio, that will produce some concerns for us. Then some rate of change charts. These are long term, going back 250 periods, seeing a little bit of a decline here. And I just use this for informational as well, where we're seeing a bit of a decline here when we go all the way back to 1980 with this chart. Then keeping an eye on bonds, we look at the relationship between cash and 3 to 7 year bonds. This is actually falling down a little bit where it had been going up. It's still in an uptrend. It would be more positive if this ratio was to continue to go down. Now, if it turns and goes back up, that means there's a lot of uncertainty about interest rates and inflation. Then we look at another area called TIPS, which are Treasury inflation protected securities, and they're currently still outperforming, even though this is in a downtrend with this ratio. When folks are worried about inflation, they're worried about interest rates going up, they prefer TIPS because they adjust for inflation and interest rates. When people feel that, okay, we've topped out with interest rates and we're going to start to come back down, then they'll prefer to get into the 3 to 7 year bonds instead. Well, with this going up, that means that they're preferring the TIPS over the more conservative bonds. Actually, TIPS are really conservative too, but they adjust. Where the 3 to 7 year bond, it stays the same. So we're keeping an eye on this. We're just kind of chopping around, not seeing an awful lot of conviction now, but there are some inflationary concerns in the market that have been around now for most of 2025 so far. This is actually a little more pronounced, even though it did decline on Friday. This is also TIPS, and then looking further out, the 7 to 10 year bonds. When this is going up, that means that there are inflation worries because interest rates have been going up. Commodities have been really strong lately as well. So yeah, this is in an uptrend and causing some concern to us. If this could start to fall, that would be more positive for the market. We look at the long-term bond ETF based on price, that's in blue, and then the S&P 500, and then look at the long-term correlation, which is pretty much flat right now. And then we look at the short-term correlation, which is actually getting weaker, meaning that they're having a tendency to go in opposite directions of each other. We do that same basic thing. We look at the QQQs, which is the NASDAQ 100 and the long-term bond ETF. This correlation is actually getting a little bit stronger. So they're having a tendency to go in the same direction at the same time. They could both be going up or they both could be going down, but they're having more of a tendency to do the same thing at the same time. And this is kind of an interesting way of looking at this. And we're not really getting anything strange out of this chart, but we take the 10-year yield in the US and subtract the German 10-year yield. And since US rates are higher, we get a positive result. And then we plot the US dollar index here, and we see that there's a pretty high correlation between the two. Where we start to go, okay, what's going on here is if we drop down into this red area. Well, we're up in the blue area, and this is what we see most of the time. So there's not anything really strange happening right now. And we want to keep an eye on the 2-year Treasury yield, just kind of chopping around, not really giving us much insight right now anyway. So I haven't been showing this chart in the videos. Then just to kind of get another look at how's Europe and the US doing compared to each other. Europe's been pretty strong. Germany's been pretty strong too. And that's when this ratio was really going up. Now there's some profit taking and they saw some recent weakness. So we are coming back down right now. But this just shows that the Eurozone ETF is outperforming the 3 to 7 year bond in the US. Then I have a number of things called possible positive scenarios that I use when the market is more in decline mode. There's a whole list of those charts, and some of those I use every day in the video. The charts that I'm not using right now, I put into this video. This first one of the percent of stocks in the S&P above their 200-day simple moving average. I have a different chart that I use every day. that studies the same thing, but it's the chart's set up a little bit differently. This I use like an oscillator. When we get an extreme positive or negative reading, we're not getting one now. When we're above 50, we're more positive. If we end up dropping below 50, that would be more negative. And so there's really not any additional insight we're getting from this chart. Use that same basic idea with those stocks above their 50 period moving average coming down and starting to drop below 50. And that's where we're seeing a little bit of weakness coming into the market. We do that same thing here with the mid caps. They're really showing some weakness right now, but we're not getting an extreme negative reading. And then the small caps, which are really showing some weakness now, but again, not extreme negative, at least yet. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.